Chris, congrats. 32 million shares at 27 bucks a share. Obviously, we'll see how it performs once the stock opens. I think I read in your S1, consumer financial services, you wrote, remains broken for everyday people. What does that mean, and why is your company an opportunity to fix that?
Well, we like to think of ourselves as ushering a generational shift in banking and the way banking works for everyday consumers. We target mainstream consumers that make up to about $100,000 a year, which is about 75% of our country. And even though we offer banking services in partnership with our two FDIC insured banks, we are not a bank. We're a technology company and a payments company at our core. And we believe that banking the everyday consumer in a payments-driven business model is far more effective than the traditional approach, which generally relies on a NIM or net interest margin type of business model. The reality is 2/3 of Americans live paycheck to paycheck, so they don't have large deposits, and banks increasingly are less likely to lend to everyday consumers. So we think that I think we've proven that a better way to bank this population segment is through a model that relies primarily on payments revenue rather than a heavy lending component.
Yeah. Now, a lot of IPOs, people think, well, it's a relatively new company. You've been at it for a while. What, 2012?
Yep. My co-founder and I, Ryan King, we founded the company back in 2012, so we're pushing 13 years. And
why so long to go public? But more importantly, what have you learned along the way? I mean, you're saying it's the early days, but you've been attacking this problem for more than a decade.
Yeah. I would say, the early days of getting the company off the ground, we were not an instant success. We had a lot of tough times in the early days raising money. When you try to convince an investor class person that banking is broken, that usually you sort of see their eyes gloss over a little bit, and they don't really connect with this notion. Because if you are a higher income consumer, banking services works reasonably well. But if you're someone in this middle income segment, it doesn't work as well. So I think the last 5 years or so, we've really broken out. If you look at survey research on top brands on an unaided basis in the online banking category, today Chime only trails JP Morgan and Bank of America. So we've really broken out in terms of being a company that consumers think of as a primary direct deposit relationship. And we help our members avoid fees, get access to short-term liquidity, build their credit, and build their savings. And it's that combination of services that really resonates and matters most to the everyday consumer.
Right, and that direct deposit relationship is obviously very important for you.
Yes.
A very large percentage of your customer base.
We have 2/3 of our customer base uses us as their direct deposit account and primary account relationship, and that unlocks a whole host of opportunities. Our average customer is doing over 55 transactions a month with our card, and if you look at the level of engagement that people have with our app and the card, it's somewhere around 4 or 5 times a day that people are interacting with Chime. So right. People think of Chime as really their primary financial dashboard for all elements of their life, and it's really working well. I mentioned to you in a prior meeting, consumers don't like Chime. They love it. They tell their friends about it, and that's it's actually our number one driver of growth.
8.6 million people,
yeah.
But what's the TAM here? What is the actual addressable market for what you're trying to do?
Well, in the medium term, we think the opportunity is there's about almost 200 million Americans that make up to $100,000 a year. We're at 8.6 million monthly actives, 2/3 on direct deposit and using us as a primary account. So we're less than 5% penetrated and a really long way to go in penetrating the everyday consumer that the big banks don't do a great job serving.
Right. You've been on your way to profitability, and obviously
yeah.
This year, I think your first quarter, you had over half a billion in revenues, so your run rate's got to be over $2 billion for this
That's
year.
Right. We grew over 30% in Q1. We reached EBITDA profitability of about $25 million in Q1, and we've seen a very healthy trajectory on that front, both the combination of top-line revenue growth, but also showing real operating leverage in the business.
Yeah. Well, all right. All right. So I'm an investor here. What's the signal for me in terms of operating leverage and why that's going to continue, and/or the benefit I would assume from scale as you get more customers?
Yeah. I mean, on an adjusted EBITDA basis, we've improved by 40 points just in the last 2 years. So that trajectory is actually moving up pretty rapidly, and at the same time, we continue to open up many new active members quarter after quarter. We had an outstanding Q1. We grew our active member base by 23% year over year. So we're seeing growth in active members, we're seeing growth in revenue, and we're seeing growth on the earnings side.
And you
as
spent
well.
a lot of money on marketing to do that. I think it's what 35% of revenue is what I read in your S1. You spent what, 1.4 billion between 22 and 24. Do you continue at that pace?
Well, we are very comfortable investing in high ROI marketing. And for us, the LTV to customer acquisition cost is something like 8 to 1. When you develop these deep primary account relationships, they pay off many, many years down the line. An average customer that's on direct deposit, as you know, industry stats show that those consumers stay active with a platform for very long periods of time. So we like how we monetize over a long period. And importantly, the way that we monetize our relationships is very different than a traditional bank. 72% of our revenue comes from payments-driven revenue when our cards get used for their everyday transactions. And we really like that because it's aligned with our member, and we aren't profiting from misfortune in the form of
so you're not
overdraft
getting
fees and monthly fees and all these sorts of things.
And all the things that people who obviously are earning 100,000 or less, it's a big hit. And it
for
means
sure.
a lot to them. That said, I think churn in year one, as I was able to understand it, is about 50%. Then it goes down dramatically. But you're losing half of those people you're spending a lot of money to get to. What do you do to improve that, and should that be concerning to some investors?
Look, it is very easy to sign up for a Chime account. You can do it in 90 seconds. So that's kind of our front door. We don't have branch infrastructure and so forth. So we definitely get a lot of trial. And the key for us is converting people to get direct deposit to a Chime account. And once you do that, year 2 and beyond, our retention rates are in excess of 90%. So that's why these cohorts last for many, many years. And sometimes for people, it takes a change in life, a change in their career, a job change to be the point in time when they actually make the switch and use us as a primary bank account. So, we love getting people to sign up for direct deposit right out of the gate, but oftentimes it happens a little bit later.
Yeah.
And I think there is an opportunity for us to do an even better job of giving people access to Chime services when they're ready to maybe date before they get married. We've done a pretty good job of getting people to convert to direct deposit right out of the gate. So
you're getting a better sense as to when that is, or when that transition, or so when you're best to sort of hit them and make them, get them to year 2?
Right. Well, no, it's happening. It's happening right now. We're doing a better job of getting people to fund their accounts and use the service even before they get direct deposit. So in some ways, you could say we're sort of increasing the size of the pond to fish in, if you will. So we've seen a lot of success in that area, and that's part of what's driving our active growth.
Yeah, that said, a lot of your users are paycheck to paycheck, and I do wonder, what the risk is if we do have a significant downturn in the economy.
Well, the interesting thing about our model is 70% of the spend that our members do is on non-discretionary payments. So they're doing it, they're buying groceries, paying utility bills. We're not as subject to the ups and downs of a credit cycle because we are primarily a payments business, not a lending business. And so I think that's really unique about the model. And even in past corrections and COVID and so forth, we actually saw that more of your direct deposit goes into your primary bank account.
But you do have these overdraft. I mean, you have this overdraft product, right? People can take up to at least $200 and they don't have to pay fees.
That's right.
Is there a risk there, though?
There's always a risk when you're doing some amount of short-term credit extension, but think about these credit lines that we're giving people, $200 of overdraft, or with our MyPay service, the ability to access your paycheck up to $500 at any point in time over the pay cycle. These credit extensions we do pay back to us in very short periods of time. Our SpotMe product pays back in less than 7 days. The MyPay product pays back in less than 2 weeks. So we really have our hands on the dial, and if we ever needed to course correct in some way, we have a high degree of flexibility, and it's not in any way a capital-intensive business the way a bank is.
As I mentioned, you have been at it for some time. It doesn't appear that the big banks are particularly interested in your customer base, I guess. But is that a risk still, that at some point they'll say, you know what, we're gonna start to try to compete here in terms of fees?
Well, I think they've tried a few times and then pulled back, but I think I would direct you to Jamie Dimon's shareholder letter, which came out just 2 months ago, and there was a passage in there where Jamie wrote that for low balance accounts at Chase, which make up the majority of our accounts, the cost to service these accounts far exceed the profit that we earn from them. he said something along
Yes.
those lines. And I think, full respect for Jamie Dimon, I think Jamie's saying out loud what a lot of other bank CEOs probably think, which is that they're way more focused on serving the needs of higher income people that they can lend to. And that's why you continue to see, innovations in the area of private client, wealth services, jumbo mortgages, super prime credit cards with travel access and all these sorts of things. Whereas we're focused on the everyday consumer and the needs that matter most to them around liquidity, avoiding fees, and not trying to disparage the bankers. They're making practical decisions around focusing their product innovation efforts on the segment of the population that they can make the most money from. Because of their reliance on a branch infrastructure and the physical acquisition and service delivery model, the mathematics just don't work. It's not a profitable segment. For us, we can enjoy close to 70% transaction margins with this huge segment of America, 75% that make up to 100K,
right,
and help them make progress in their financial lives.
How many employees do you have?
1,400.
1,400.
Yeah, 1,450.
And you're going to be a public company soon. And I think it's 25.9 million shares are being sold by the company, so you're raising that money, another 6 million or so by existing stockholders. What are you going to do with that money? I mean, is it going to enable you to do what? Hire more people, more infrastructure?
Honestly, we didn't have any capital constraints. So we think that going public was just a natural step in our evolution as a leader in our category and as a consumer brand. We're really excited about becoming an even more well-known company. We will be raising some money. We'll be using a good portion of those proceeds to pay the taxes on the double trigger RSUs for so many of Chime employees that will have a tax due bill upon the transaction. So that's actually where the majority of the proceeds will go. And the rest will be, we think having about $1 billion of cash makes sense for a company.
So a lot of it is kind of a marketing exercise.
It's a little bit of a marketing exercise, yeah. But
maybe we'll be talking about it on CNBC. You're right here. I mean, it does help, I guess. But is there something else in terms of the audience or your potential addressable audience that they care whether you're a public company or not? I
think, as a company that is really a digital-first company, anything you can do to have more connections to the physical world is goodness.
Right.
And our aspiration is to be a generational brand that sets a new standard in banking. And of course we need to be a public company in order to do that. And it obviously opens up lots of opportunities in the area of M&A and growth and just general corporate flexibility.
Yes, of course you'd be able to use a currency if you choose to. Are
there
opportunities?
We've had shareholders for 12 years.
You have, I know.
We've got employees
and you thought you might go public at a different time. I mean, you had a valuation far above at least what we're going to see at the open tomorrow, right? This company at some point in the private markets was valued at close to $25 billion.
Yeah, in our last financing back in 2021, obviously that was a different point in time. We've grown substantially since then and have now reached profitability. So, the price of stock fluctuates. I think for us, nothing wavers in terms of our focus on obsessing over the needs of the everyday consumer and doing a better job of banking them in this payments-driven business model that we have, which is so different than the way traditional banks go to market.
And what about you? You've been at it for a while. I did note, and this is, compared to your customer base, or most people, you're going to own 5% or so after the IPO, which is going to be a significant sum, but it's not that much compared to a lot of founders. How did you get to such a low number, and does it incent you enough to want to continue?
Oh, I'm very satisfied, and I have no regrets on the path that I've taken. I've got a co-founder, and we have been a private company for some period of time, and I have more than enough motivation. I don't even need financial motivation to continue. Professionally, this is my life's mission.
Why is it your life's mission?
Well, I grew up in Mount Vernon, New York, and I grew up in a lower middle class family, and through a little bit of luck and some hustle and some grit, I was able to break out, go to college. Neither of my parents graduated from college. I think this is an example of an American success story, and I'm incredibly proud of that. And I think anything we can do to help unlock financial progress for Americans is something that just really resonates with me, resonates with all of our company. In fact, one of the things you may have read in our prospectus is that we've decided to allocate 1% of our shares into the Chime Scholars Foundation, where we actually fund post-secondary education opportunities for not just Chime members, but for others who demonstrate grit and hustle and maybe come from non-traditional backgrounds, and maybe you're juggling the realities of life at home, managing a family, but also trying to get post-secondary education, four-year college, community college, technical training. We're really excited about setting an example and trying to give back like a good corporate citizen. So I think it's in the DNA of the company. I think you'll feel that.
5% is enough. Now that said, you do have voting control along with your co-founder.
Yep.
That's not going anywhere.
No. If you invest in Chime, you're investing in a founder-led company that is, I think we've demonstrated pretty good success and a focus on delivering excellent services for this huge population segment. We intend to do that for years to come. And we think that, and I think our board agrees, that allowing us to have full control and not have to worry about the sort of short-term interests of the stock is the best approach to ensure longer-term success.
And you're going to keep that thing on the Dallas Mavericks jersey?
We've got a little bit more time.
You got really lucky there with that #1 draft choice.
We got Cooper Flagg. I just got a photo. I don't want to announce anything yet, but I just got a photo of Cooper Flagg wearing certain gear and using a certain card.
There you
I
go.
probably wasn't supposed to say that.
He's out of your demographic, though, already in terms of money. I can guarantee you that. But he's a young guy, so
he is. He's great. We're excited. Cooper and all of the Mavs team. We love that. We love that team, and it's been an awesome run for us. So who knows what the future holds? But we've been very satisfied with our relationship there.
Yeah. Well, speaking of the future, we'll see how the stock opens, of course. But certainly appreciate you taking time. Congrats again on the IPO.